You need to keep a certain amount of dollars because that's still our current tool of barter.
Right.
But I don't hold more of them than I need. And I only hold as much of them as I don't care if I can't use them, if they lose all value.
Right.
Because I have gold and I have silver to balance that out and recoup those losses and put me in a position like Steve Mnuchin is to take advantage of this crisis because I hold my purchasing power.
In this video, we explore Lynette Zang's alarming forecast. Lynette Zang is a seasoned analyst who's sounding the alarm on a potential financial storm ahead. And her latest prediction is a wake-up call for anyone with $1 in their pocket or a penny in the bank. She's talking about gold, not the stuff of jewelry, but the kind that might save your savings when times get tough. Debt piling up worldwide, and Lynette's got her eye on the ticking clock of rising interest rates. And if you think inflation's just a word, Lynette's here to tell you it's a thief in your wallet, stealing the value of your hard-earned cash. She's seen it before in places like Zimbabwe and China, and she's here to help you see the signs before it's too late.
It certainly could postpone it, but it won't postpone it for that long because they are also, and they know this. So if they're balanced with gold, but if they're not balanced properly with gold, they're still getting all of these underwater assets, but they're buying them when they're underwater, right? So the current banks that are holding them, they're the ones that are underwater. When Steve Mnuchin came in and bailed out that bank, he was paying this much for those bonds, not at market value. And it makes it even more dangerous. So it could certainly postpone it. I think that we could definitely see it because, first of all, private equity, even though they can influence those that print the money, they can't print the money.
Mm-hmm.
So those assets, if interest rate, okay, this is what I think is going to happen, okay? So we've got all these underwater assets and we have this huge mountain of debt that is resetting this year, next year, and the following year. Huge. At the higher interest rates, forcing the global central banks, and this is happening now too. You hear everybody talking about global central banks, different ones discussing when they can lower rates. And even our Fed saying, well, it's not quite time yet, but maybe sometime this year. So it's going to force this looming mountain of debt is going to force a Fed pivot. Now, when the Fed pivots and they drop those rates, that will increase the current market value of the bonds. So for a second, that can look okay, but that's also inflationary. And much as the global central banks, different central banks are wanting to lower those rates to stimulate their economies, because that worked so well for 15 years, didn't it? That higher inflation erodes confidence. When the public can see it, it's going to be the public that ultimately, it'll either be the public or it will be this next big crisis that is not bail-outable, that will make it obvious to the public. But there's only one layer of confidence left in here, and that's public confidence in this printing press, in that the central banks know what they're doing. Rapid inflation erodes that confidence. And there's really no valuations left because officially, if we're at 3 cents left on a currency, like that's the official number of the value of the dollar.
Lynette Zang predicts a financial shift that could impact everyone. She talks about the risks in the banking sector and how gold might be a safer bet. Here's a simple take on her complex ideas. Banks are in trouble because they own assets that are losing value. These underwater assets are like owning a house that's worth less than the mortgage. When the value drops, it's bad news for banks. Lynette mentions Steve Mnuchin, a guy who once helped a bank by buying its bad bonds not at their real value, which was risky. She thinks private equity firms, groups that invest in companies, can't save the day because they don't control the money printing. Central banks do that. This year, a lot of debt, or money owed, is due. It's like a big bill coming up. And because interest rates are high, it's a bigger bill. Central banks around the world are thinking about lowering rates to make things easier. If the US Federal Reserve, or the Fed, lowers rates, bond values go up for a bit. But this can also make prices rise everywhere, which is called inflation. If things cost more, people trust money less. Lynette believes if inflation keeps going up, either the public will lose trust or a big crisis will happen that can't be fixed by bailouts. She warns that if the dollar's value keeps dropping, and we end up with negative interest rates, people's savings will shrink. Negative rates mean you lose money just by keeping it in the bank. Japan tried this and just stopped.
Well, if it goes to zero, but people continue to use it, and then it goes to negative rates, and they experimented with that since 2009, Japan just came out of negative rates. So what does that exactly mean? It means you're going to watch your principal be eroded in this banking sector. If you're putting your wealth in there, you're putting money in there, and you're trying to save.
Right.
When you go to the digital currency, the CBDC particularly, there's no place to hide other than gold and silver. There's no place to hide. Well, the original dollar, and you can see the basket of food that dollar used to buy, right? Today, when you go to the grocery store with $1, are you actually even is there anything in the grocery store that's $1?
No, they've had to recently shut down the dollar stores. I think about 100 dollar stores have had to shut down. Lynette, the other day I was commenting, you used to get a dollar pizza slice. It's $1.50 now or $1.25. Can't even get a dollar pizza slice. There were places in New York, $1, one slice of pizza. But go on.
Well, but that is the point, because people are noticing that. If they can have that loss happen slowly, like they have 2%, right? That's where you have that 2% target. People don't notice it, and therefore they do not change behavior. For central banks, that's what they refer to as price stability. Not that the price stays stable or the same, but that the public does not change their spending behavior. However, when inflation happens rapidly and you notice that dollar slice of pizza is now $2.50, and that happens, if it happens over a long period of time, you kind of adjust to it. But if it happens in a short period of time, which is what's been happening, well, then you notice it and you go, I don't trust this anymore. And we've been watching confidence, the public confidence, erode over time enough that there's just not that much confidence. And once you lose that confidence,
right,
they use gold. Look at Zimbabwe. They use gold to try and get that confidence back.
Right.
People have confidence in the physical, but their gold-backed CBDC, they're having trouble getting adoption because you cannot convert that CBDC into the hard asset, into gold itself. The monetary velocity, basically, if you take on debt, and that can be stimulating, but that monetary, the number of times that the money changed hands, let me make it simple. Let's say I had a good week and I've been needing a new car. So I have the confidence to go out and buy that new car because my income's pretty steady and I feel like, okay, it's going to stay that way. So I go and buy that new car. Now, whoever sold me that car, that salesperson made a commission. And maybe there was they wanted to take their husband on a weekend vacation somewhere. But now, since that money changed from my hands to their hands, they feel confident in doing it and they go on vacation and they're feeling kind of flush. So they go to a restaurant, they leave a large tip, and now that wait person can maybe buy the sneakers that Johnny needs, right? So the number of times that money changes hands.
Lynette suggests that when digital currencies like CBDCs come, the only safe place might be in precious metals like gold and silver. She points out that $1 doesn't buy much anymore. Even dollar stores are closing because things cost more than $1 now. Central banks want prices to go up just a little, like 2% a year, so people don't panic and stop spending. But when inflation is too fast, people see their money buy less and less. They start to lose faith in the currency. Zang points out that in Zimbabwe, they used gold to bring back trust. Gold is something people feel is always valuable. But digital gold currencies are tricky because you can't turn them into real gold. She also talks about how often money is spent, called monetary velocity. If you buy a car, the seller might use that money for a trip, and the cycle continues. This shows a healthy economy. But if people are scared of inflation, they stop spending, and the economy slows down. Zang warns that when money loses value very fast, it's called hyperinflation. People then rush to buy things like gold that won't lose value. In an interview with investing.com, Lynette Zang shared a stark warning. She advised on the need for physical gold and silver to safeguard against economic issues. She pointed out that owning gold and silver is the safest way to protect oneself. Zhang also noted the importance of watching monetary velocity. This helps predict market changes and signals hyperinflation.
Now, you might remember that it was 2006 when the Chinese government allowed their population to buy gold again through the banks and hold that gold in accounts at the banks, which would make it very easy to confiscate whatever gold is held in the banks. But the Chinese public that have been trying to build their wealth in real estate, that's probably the key asset that they hold, but in their stocks and their bond market, and in their private shadow bank market, I mean, they've been watching their wealth implode, and now they're rushing to the safety of gold. And the beauty part about gold or silver or any of that, regardless of its form, it is monetary at its base. So this gives me hope for our future, because we're watching a society that is so suppressed break out of that mold and then try and do things that will protect their wealth, because they know now the truth about the fiat system, as you pointed out.
She recalled 2006 when China let its people buy gold. This move could lead to easy confiscation of bank-held gold. The Chinese have seen their wealth in real estate, stocks, and bonds shrink. Now they turn to gold for safety. Gold and silver are money at their core. Zhang sees hope as people learn the truth about fiat money and seek to protect their wealth. She suggests diversifying into assets like gold and silver. These have been stable in past crises. She doesn't claim the US is in hyperinflation now, but she warns that a spike in monetary velocity can mark the start of such an event. She also quotes Ernest Hemingway on bankruptcy: "It happens slowly, then all at once." The same goes for hyperinflation. Many don't see it coming because they're not looking. But Zhang is prepared with gold and silver to balance out any losses. And that wraps up for us, but if you found this interesting, then don't forget to hit that like button and subscribe for more insights and updates. Until next time, stay prepared.